Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, it's all about Silicon Valley Bank, including what happened, why it happened, how we can prevent it in the future, and what you need to do as a bank depositor and investor in the bank and brokerage community. We talk about the details of FDIC and SIPC insurance, what the federal government and Federal Reserve can do to step in now, and the tightrope that they're walking between quelling the risk of bank-run contagion and moral hazard in the banking industry. These are all pretty big issues, and we tried to dive into each of them one by one in this week's episode. This is an evolving story. We'll probably have more to say about it in the coming weeks, but for now, this is what we've got, and I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hey, everybody. We are here today in this week's episode to talk about Silicon Valley Bank, First Republic, banking in general, and what we need to be thinking about right now in terms of cash deposits and savings, what it means for the broader banking system, and what it means for cash that you might have sitting in a bank account of your own or of your businesses. There are a whole lot of items to unpack with this whole Silicon Valley Bank failure and its sister entity, Signature Bank. This whole situation kind of went sideways on Silicon Valley Bank in a hurry. So what I wanted to do in today's episode is comment on that, walk through everything that happened, why it happened, what you should be thinking about as an investor and a depositor and user of the banking system, and what I think we should be doing as a country from a policy perspective, because this is a balancing act that our federal officials are walking right now for a number of different reasons. And if their intention is to maintain the integrity of the banking system and promote economic growth, I have a couple of thoughts on what probably ought to happen. I don't know if these things will happen, but they seem relatively obvious to me that there are a couple somewhat easy check marks to go through if the whole system is to function properly and smoothly and efficiently. So let's start today by going over what happened with Silicon Valley Bank and why it's important, why we care about it. Basically, there was a run on the bank. So all those old movies about the Great Depression and people lining up outside and fighting and putting their arms through the cage where the money is held in the back of this bank that sits in an old Western town. That's kind of like what happened here. Silicon Valley Bank is a bank that worked primarily with startups, many of which were venture capital backed. So they had a lot of cash because they sold the vast majority of their equity to a venture capital firm that helped them grow their companies and provided them with connections and resources and all of this, right? And so that's relevant because if you or I were to go out and start a new company, we come up with a business plan, structure an entity, we go start staffing up, hire employees, and go deliver our product or service out there into our target demographic. We're going to open a bank account, and it's going to have some cash in it that consists of money that the founders and investors have put in. And if you go out there and you sell a stake to a venture capital firm that's going to provide you with a lot of economic resources, you almost always have a heck of a lot more cash in a venture-backed entity than you do in any other kind of startup. If you and I are trying to bootstrap together a company to do, go sell ice cream cones, we might both put in $20,000 a piece. And so we start with $40,000 in the bank, which not coincidentally is under that $250,000 FDIC coverage limit. If we went and sold our idea to a venture capital firm, they might give us a couple $1 million to put in the company bank account and use to accelerate growth, right? So this is relevant because Silicon Valley Bank really played in that space of helping founders of startups and the startups themselves. And one of the interesting statistics here that we'll get into is that the vast, vast majority of their deposits at the bank were not covered by the FDIC through their traditional limits of $250,000 per entity. And so if you compare that to most other banks, so for example, we used Charles Schwab as our investment custodian at our financial planning firm, and I am one of my duties as the owner of our firm is to make sure that Schwab has adequate capital and is able to deliver the best service for our clients that they can. Well, I think it's 80% of Schwab's bank deposits, not the brokerage side, this is a different entity, the bank, were covered with the $250,000 FDIC limit. Compared to Silicon Valley Bank, that number was 2.7%. And so if you compare Silicon Valley Bank, they're working with a smaller number of individuals, a smaller number of entities, and the amount of money that each of those customers, each of those entities had at the bank was substantially higher compared to a more traditional option. I don't know what the numbers are off the top of my head for JP Morgan or Wells Fargo or US Bank or any of these other big players, but at Schwab, about 80% of their bank deposits are covered by the FDIC standards. So Silicon Valley Bank had a situation where they're more likely to run into trouble under signs of stress because they have fewer customers and more of those deposits, a far larger portion of their deposits were not covered under FDIC. And so because those customers had more at risk, more to lose, it's more likely that if there's bad news coming out, that since A, they have more to lose, and B, there are fewer of them, it takes less of a push for that contagion risk and that momentum to build to where all those customers want to pull their money out all at once. And that's what a bank run is. Remember, a bank is out there taking money in from customers who are holding their money at the bank and depositors like you and me, checking accounts, savings accounts, CDs, money market accounts. All that money comes into the bank, and then they turn around and lend it out somewhere else through business loans, mortgages, revolving lines of credit, credit cards, other types of loans. Lots of banks, Silicon Valley Bank included, will go out and buy U.S. Treasury securities. And so if they're paying you 2.5% on your savings account, they're going to want to take that cash and lend it out at an interest rate of greater than 2.5%. Let's say 5% on a longer term U.S. Treasury security. And so if that's $10,000 and they're paying you, well, let's make it easy. Let's make it $1,000. You deposit $1,000 into the bank. They pay you 2.5% on that. That's $25 a year. Then they take that cash and they go buy an interest-bearing security or lend it out to somebody else. They earn 5% on it. They get $50 a year coming in from their loan, and they have to pay you $25 of that, and they get to keep the other $25. So that's how banking works, and I'm guessing that most of our listeners have a pretty good understanding of that concept in general. You take money in and pay a certain rate out, and then you take that cash and you invest it or lend it out for a higher interest rate, and you pocket the margin. Not every single dollar that comes into the bank can be lent out to another party. There are reserve requirements. The bank has to keep a certain amount of cash around. The problem that we run into in the banking system is when all those customers want their cash back all at once. It means that the bank has to go into their loan portfolio and call the cash back, and that can create liquidity problems, right? If The bank takes in $1,000 from a number of depositors, and they go and lend that $1,000 out to earn 5% and then pay the depositors out 2.5%. Well, if all the depositors need the cash back at once, they're going to have to sell the loan, and that can be detrimental to the bank, because if they sell the loan at a loss, then that's not good for business. That impacts profitability. And in reality, there are different reserve requirements for different types of assets. This is part of the Dodd-Frank legislation after the mortgage crisis in 2008, 2009. It would be nice and clean and easy to say that of all the money that comes into a bank, they have to keep 10% of it, and then they can lend out the rest. So if they take in $1,000, they can use $990 to go buy some of their security, and then they only have to keep $10 of it. If it's a 1% reserve requirement, 10%, maybe they keep $100 and then lend the other $900 out to another party. It's not that clean cut. There are different requirements for different types of deposits and different types of loans and assets and so forth, and it's a rather complex system. But the crux of it is that if all the depositors want their money back all at once, it forces the bank to raise cash. And if they can't, because they need more time to sell the treasuries or whatever the assets are that they have in their loan portfolio, that's what creates the liquidity crunch. And so for Silicon Valley Bank, looking back over the last couple of years of history, their deposits grew at an astronomical rate. They're taking in tons, and I think I saw somewhere that they tripled deposits in the last 3 years or 5 years. Or they're growing at a rate that's unsustainable. So they were forced, when all this cash is coming in, remember that they're paying depositors an interest rate for that cash. So they don't want to allow that cash just to sit in their own account somewhere. They really need to get the money working for the bank by purchasing loans, lending the cash out to other parties. And Silicon Valley Bank would provide like big mortgages to their founders. They would purchase loans of other publicly traded companies and do a variety of things. But the cash was coming in so fast that they were struggling to place it in areas where it made sense. And so at some point along the way, they took a bunch of the cash and bought U.S. Treasuries with longer maturities. And so ordinarily we think of the banking system taking in cash from depositors and then going and lending that cash out to businesses for maybe like an SBA loan or to buy a commercial building or something like that. Well, in this case, Silicon Valley Bank was doing all those things, but it had more cash coming in than it could really handle, and it purchased U.S. Treasury securities. So what is the risk there? Well, the risk that the bank would not get its money back is very, very low, because you or I, as individual investors, can buy the exact same U.S. Treasury securities. It's just a loan to the U.S. government. The chance of the U.S. government not paying that loan when it comes due in a couple years down the road is very, very low. The risk is what happens to interest rates. And so as we all know, interest rates have gone up over the last 12 months or so, pretty aggressively, because of our inflation concerns. And so as we've talked about on the podcast, if you own a 10-year U.S. government security that pays 4% per year, and then inflation comes into the picture and the Federal Reserve has to raise the interest rates, and now the market rate of interest on U.S. government debt is 5% instead of 4%, your bond doesn't look as good as it used to. And it loses value in the secondary markets. And every year that you get closer to that maturity date, when you get your money back and can reinvest at a higher interest rate, the value of your bond appreciates. And so the longer, in this kind of scenario, when interest rates go up, the longer the maturity date of your bond, the more duration and interest rate risk that you have. So for Silicon Valley Bank, I don't know all the intimate history here, but I've been reading avidly on this, and from what I can piece together so far, they grew their deposits at an unsustainable rate that could not be matched by their internal loan portfolio. They didn't have enough borrowers to place all that cash coming in from deposits. So they purchased U.S. government securities thinking that they were investing in a very safe security, which they are from a credit risk standpoint. But they made the mistake of going out on the maturity curve and buying bonds that would mature in 7, 8, 10 years instead of shorter durations like 1, 2, 3, 5 years. And so since interest rates have gone up dramatically over the last 12 months, really, that's pushed down the value of those securities in a big way. So if a banking executive is in this situation, you're sitting on unrealized losses. And as long as your depositors keep their cash in your bank and they don't pull out, then you're going to be fine, because the bank will continue to get closer and closer to the date at which those bonds will mature. The federal government puts cash back in the bank's own account, and then you have the cash free and available to return to depositors if they decide to pull out. And in this circumstance, the executives took a bunch of duration risk by purchasing the bonds in the manner that they did. And then when interest rates went up, if they had sold those bonds for security, for safety of their own portfolio, really, if the values go down, their risk of a bank run is higher. And a prudent manager might see that and said, hey, we need to get out of these positions and raise liquidity. They decided to play the aggressive move and not sell those securities. Because if let's say they took $1 million and bought 10-year U.S. government securities, now interest rates have gone up and they've fallen in value to $925,000, right? So they have an unrealized loss. And you know that the closer you get to maturity, the more that value is going to rise closer to the $1 million that you lent the U.S. government. It's an inevitability as long as the U.S. government doesn't default on its debt, which is, aside, even amid the political environment we're in right now, is a very, very low likelihood of happening. So they know if they could just hang on, that these securities will mature, cash goes back to the bank, which is then free and available to return to depositors if the depositors want their money back. But they decided not to do that, because if they sold, they decided not to sell. If they had sold, then that amount of loss, which in this case is $75,000, goes on the income statement. It shows up as a realized loss, it doesn't make managers look good. So they rolled the dice on this, chose to maintain their positions as opposed to raising cash, and kick the can down the road in the hopes that depositors wouldn't demand all their money back at once. But the situation started to get worse and worse because interest rates kept going up and up and up and up. And so it sounds like in February, management of Silicon Valley Bank reached out to Goldman Sachs for help recapitalizing the bank. This is often what happens in the banking industry when any entity realizes that they're in trouble and they need some help getting out of the situation. And so what can they do? Well, one option would be to sell those treasuries at a loss, realize the loss on their income statement, which makes management look bad, but puts the cash back in the bank. You could also find some other creative way to raise assets at the bank by selling equity shares, by raising other debt. There are a lot of strategic options that banks can do in these situations. And your first call usually is some kind of investment bank or one of the major corporate finance entities. There are some private equity firms that often deal with this as well, but Goldman Sachs is like the number one player when things get tight and you need to come up with some creative strategy. So that's exactly what the executives at Silicon Valley Bank did. They realized that they were out over their skis with regard to their loan portfolio, their assets versus their liabilities. They needed some help and some funding, so they reached out to Goldman Sachs. Somewhere along the way, Goldman Sachs is working on helping them, arranging some ideas for them to consider. Somewhere along the way, word leaked that Silicon Valley Bank was in trouble. And so now, all of a sudden, Silicon Valley Bank has all their depositors rushing in, trying to take their money out of the bank. And it put them in that bank run situation where they had all their assets in these longer term securities that if they liquidated to meet their redemption request, it would trigger a big loss. And not only is that good, but now they don't have enough cash to replenish the. Not only does it make management look good, but now they don't have enough cash to return to the investors because of the way that interest rates have moved against them. So they made a couple strategic mistakes here, and the first one was what they had way too much duration risk in their bond portfolio because of all the deposit growth that they've seen over the last couple of years. There was simply no way for them to raise enough cash in time to meet all the claims, given the way that interest rates moved against them. So in a nutshell, that's what happened. And because of the customer base of Silicon Valley Bank, remember, fewer customers with far more money in each of their accounts. Each of those customers had more to lose because the vast majority of their customers' accounts were above that $250,000 threshold that's insured by the federal government. And remember, these are businesses that have payroll demands and are monitoring their financial status very, very closely. So this spun out of control. People demanded all their money back, and now all of a sudden there's no money to be returned. So they have to figure out creative ways to get out of this situation that they're in. One of them is a strategic sale. That's an option in a situation like this where the government can step in. And as soon as there's risk of contagion where depositors are at risk of not getting their money back, that's when the federal government steps in, right? When the executives reached out to Goldman Sachs in February, they know they're in trouble, but there are no depositors that are not getting their money out of the bank yet. When depositors can't get their money out, that's when the Fed step in, or very close to that is when the Fed step in and try to arrange some kind of transaction to recapitalize the bank in a way that wipes out the equity but preserves customers' deposits as best as possible. So what that means is they get a bunch of the big banks executives in a room and try to coordinate something. This happened in 2008, 2009. There are some really great movies about it. If anybody's interested in great books about it, Margin Call is a good one. I'm trying to remember the other one. Paul Giamatti, I think, played the Fed chairman at the time. Really great movie that goes over all this. But you get Wells Fargo, JP Morgan, Citibank, and a couple of the other major players in a room and try to coordinate some structured sale to where the value of equity of the bank basically goes to zero or thereabouts, but the debts are restructured in a way that makes it attractive for a bigger bank, yet doesn't wipe out depositors. So that's one possibility. Another possibility is that the federal government steps in and rather than coordinate some kind of structured sale, guarantees deposits above the FDIC threshold. And that's exactly what they did in this circumstance. So as you may be aware, the Federal Deposit Insurance Commission or corporation, I can't remember what it is, cooperative, something like that, that's the program that every single banking institution pays into. It's basically a form of tax on a bank for federal coverage. And what that means is that the bank has to pay into this system where the federal government insures deposits up to a certain amount. And when you and I put our money into a bank through a checking or a savings account or a CD or any other FDIC covered product, if that bank goes under, as SVB just did, the federal government will step in and give you your money back up to those thresholds. The legal terms here are that each legal entity is guaranteed $250,000 of coverage. So if you have an account for yourself in your name and an account for your spouse has an account in their name at the same bank, even though you're married, you'd both be covered by $250,000. And in some circumstances, you can do the same with trusts, particularly if you have an irrevocable trust, maybe accounts in the names of your kids. Each legal entity is afforded up to $250,000 of coverage. If you have an account with $500,000 in it in your name, then half of that, the first $250,000 is coverage, the other is covered, the other $250,000 is not. And so in this circumstance, the federal government is trying to do a couple different things. They have a balancing act because what they don't want to do is convey this moral hazard that they will guarantee all deposits no matter what. But if they do not step in and do something, then what are all the startup and venture firms that have money in other banks other than Silicon Valley Bank going to do if they allow Silicon Valley Bank to fail? They're going to pull all their money out of their respective banks because they're scared that their bank will go under because they're tied to this. What are other investors going to do that are not related to the startup community but are concerned about their the status of their banks? They're going to run and pull their money out. So the risk of contagion here is very high. And first and foremost, the federal government, through the Federal Reserve System primarily, and Janet Yellen, who's the Treasury Secretary, they're trying to promote stability of the financial system, which is paramount and priority number one. But they also don't want to create this system where people just assume that the government's going to bail them out, because that's a huge problem as well. So what they decided to do was guarantee deposits of Silicon Valley Bank depositors regardless of the amount that they had in the account. So even if you had $1 million in a cash account at Silicon Valley Bank, the FDIC is now going to come in and make you whole. And they did so in a pretty efficient way, to where I believe depositors just this last Tuesday were able to get their cash out if they wanted to, after a huge amount of risk through the weekend and a huge amount of uncertainty. And this will be about a week and a half old by the time this episode goes to air, just to put a timeline on all this. So the problem with this is that it creates a moral hazard, right? It promotes, yes, insuring bank deposits without limit promotes stability in the system, right? Maybe it prevents the next bank from going under. It keeps some businesses some startup businesses from pulling all their money out of other banks. First Republic is a good example of that. But it creates this other problem called moral hazard. And that's one where if the federal government sticks to its $250,000 limit, then all the other depositors, you and me and all of our businesses included, have to really think twice about how we're handling cash. Because there might be a bank down the street that's offering a better rate of interest on our deposits, and we might want to put all our cash there. But if you've got $3 million in cash in your business's account, the vast majority of that is not going to be covered by FDIC. So we have to think about that and make a decision. Maybe spread our cash across a variety of banks to remain under those limits, or at least realize that if we take all our cash and put it with this bank offering a higher interest rate, that there's a substantial risk there that, hey, if that bank goes under because they grow too fast, they take on more deposits than they can really reinvest, and that forces them into longer dated securities. Hey, if interest rates rise, that could put our deposits at risk too, which is a huge risk. So by guaranteeing deposits over and above the FDIC limit, without limit, right? By guaranteeing all deposits at Silicon Valley Bank, the Fed is creating this moral hazard, where the general public and depositors across the world really might not think twice about that issue if they expect the federal government to come in and insure their deposits too the next time that happens. So here's an example of that. If you and I become really confident that the Federal Reserve and the federal banking industry is going to come in and guarantee all deposits no matter what, what's to stop you and I from starting a new bank, offering the best interest rate in the country to all depositors no matter what, right? So let's say that the leading banks out there are offering 4.5% interest right now. Let's say we offer everybody 7.5% interest. Well, let's make it a little more reasonable. Let's say we offer depositors 5.5% interest per year on their deposits at our bank. And all we're going to do is take that money in. We're going to keep the minimum amount on our own balance sheet, or on our own in our own reserves, I should say, that we need to abide by the figures authorities tell us that we have to, and take all the other cash out and invest in super long dated and super risky loans that pay 8% per year, knowing that there's a pretty high likelihood that a bunch of them are going to default. We have a ton of interest rate risk. But in the meantime, we'll be pocketing the difference between the 8% that we get and the 5.5% that we have to pay out. And because of that, we'll fill our own pockets, because as executive management of our bank, we'll be incentivized by a portion of the profitability. Our bonuses will be funded by how profitable the bank is. But guess what? Because our depositors, and because we know the federal government is going to step in and make everybody whole if we take too much risk and get out over our skis and it goes sideways on us, we don't have any disincentive not to do that. And so that's a moral hazard. It's a very real situation. And the tightrope that the federal government needs to walk is communicating in a way that prevents contagion. It prevents this bank run from spreading to other entities and across the banking system, but also minimizes that moral hazard going forward. And this is where you may have heard, and this may ring a bell from years ago, about, 15 years ago now. Holy smokes, it's been a long time since the 2008-2009 mortgage crisis, but this designation of systemically important financial institutions. If our biggest financial institutions went bankrupt, that's going to drag the economy down as a whole. And if the banking system doesn't operate, that's bad for everybody. And so the federal government wants to prevent that without creating this moral hazard. And by law, my understanding is that if they designate an institution as a systemically important or systemically relevant, I can't remember the exact terminology, institution, that gives them latitude to take more extreme measures. I believe, based on what I've read so far, that Silicon Valley Bank was labeled a systemically important institution, which allowed the feds to come in and insure all deposits above the $250,000 limit. So that's the tightrope that they're walking. They want to prevent this bank run from spreading to other institutions without creating this moral hazard. Now, as I sit here and record this, First Republic is another bank that works with startups in a similar community. They have fewer depositors with far greater balances. They've come under a lot of financial pressure as well. And it's not even, I don't know the details of their investment portfolio, the bank's loan portfolio, but even if they don't have the exact same interest rate risk that Silicon Valley Bank had, which put them in the situation, just the rumor that your deposits might be at risk is enough to add fuel to this fire of a potential bank run. And if more and more depositors come out and try to get their money out of the bank, that creates more pressure on the bank, and therefore a greater likelihood of wildfire catching and this thing spreading to other institutions. So this is the situation that we're in as depositors. It's the situation that the Fed is in as a bank, and the federal government is in as an institution. They're trying to walk this tightrope between those two things. Now, a quick point of clarity here that I would guess a lot of listeners are wondering about. The FDIC covers bank deposits, not securities accounts. Bank deposits have to be segregated and accounted for completely separately than securities you might own in an investment account. So if you have a bank account for your household, that's your emergency fund, maybe you have $100,000 in there, that's under the $250,000 threshold, those bank deposits are covered by the FDIC. Let's say that you have an IRA or a taxable account in your name, and it's got $1 million of stocks and bonds and ETFs and mutual funds in there. That account is not covered by the FDIC because the account is in a brokerage account that has to be treated completely separately than a bank. And this gets confusing because most of our major financial institutions, Morgan Stanley, Schwab, Fidelity, E-Trade, Citibank, Goldman Sachs, JP, they all have multiple entities underneath their corporate umbrella. But your bank deposits that sit in a checking or savings account are in that entity's bank. Your investments are in that entity's brokerage, which is a completely separate entity. So FDIC coverage does not apply to your investments. For your investments, there's a different kind of federal coverage called SIPC, or the Securities Investors Protection Corporation, which is the same idea. All the brokerage firms in the country have to pay a little bit of money to be a part of the system in exchange for being licensed as a brokerage firm, basically being legally allowed to operate in that capacity. And if your brokerage firm happens to go bankrupt for whatever reason, if your securities are lost in that bankruptcy, SIPC protection covers you for the first $500,000 worth of security, including up to $250,000 of cash. So if you have $500,000 sitting in cash in a brokerage firm, this protection, SIPC protection, only covers the first $250,000 of it. But if you have $500,000 of stocks and bonds, then if those stocks and bonds are lost for whatever reason in a bankruptcy, which typically happens only because of fraud, this is not a situation where banks take securities out of your account and then go sell them for their own profitability. It's a totally different scenario. Usually, SIPC protection only comes into play in a fraud scheme. You're covered up to $500,000. Again, this is per legal entity. So if you have an account and your spouse has an account, you both have $500,000 of protection. If you have $500,000 in two different taxable accounts in your name, you're only afforded $500,000 of protection. This also doesn't incorporate loss of value in those securities, which is relevant. If you have $500,000 of Citigroup stock in your account and it's held in a JP Morgan account and JP Morgan goes bankrupt, it's likely that if JP Morgan goes bankrupt, the value of Citigroup stock on that day is probably going to go down because they're very related entities, and the market for Citigroup equity holders is not going to like that. So what this means is that if the value of your stock gets cut in half and it falls from $500,000 to $250,000 because JP Morgan just went bankrupt, if your shares of Citigroup are lost in that bankruptcy for whatever reason, maybe there's this fraud scheme or something else, I'm just spitballing here, the SIPC is going to come in and replace your Citigroup shares. But they're not going to give you $500,000 worth of shares because that's not what you lost. You just lost the shares. They're going to replace the number of shares you lost, which are now down to $250,000 of value. So that's an important distinction when we talk about SIPC protection versus FDIC protection. So for anybody out there who's concerned about the protection of your assets in your bank or investment accounts, that's how it works. Now, another interesting tidbit here is that brokerage firms understand that a lot of people around the country and around the world have accounts worth a lot more than $500,000. And those are often the players that they're marketing to because they're more profitable for the institution to service. So to reduce that drawback, that SIPC limit, if I have $5 million in an account and some broker out there is trying to win my business, they know that I'll be concerned about that $500,000 limit. And so to deal with that, a lot of brokerages will take out insurance policies that covers you for far and above that $500,000 limit. And often this is done at some of the world's biggest insurers. Lloyd's of London is a pretty popular one. If you have an account at Schwab, for example, and Schwab goes bankrupt and you lose securities, they have an insurance policy through Lloyd's of London that will cover you for up to $10 million of loss. There is an aggregate protection limit on there too. I don't know what that is off the top of my head. That could come into play and be an issue, but there is coverage up and above that, up above that $500,000 limit at most brokerage firms by virtue of these insurance policies. So it's something to be aware of. Now, a couple things that I think we need to be cognizant of here. Number one, if I'm a federal regulator, this $250,000 limit is not high enough in this day and age, particularly for businesses. But I don't think that it makes sense to go to FDIC infinity or insure all banks' deposits all the time because of that moral hazard we were talking about earlier. But by and large, if I'm the owner of, I don't know, a series of dry cleaners here in my local area, and we do, I don't know, $5 or $10 million in sales, and we keep 6 months worth of cash in our business bank account as our working capital and our emergency fund, that's going to be far in excess of $250,000. And there are a lot of businesses that fit that profile. And so by and large, I think this FDIC limit of $250,000 is somewhat outdated and needs to go up. But at the same time, we need to stick to whatever that limit is. Maybe that limit needs to go to $1 million or $1.5 million of federal coverage. But I think we need to be really, really careful about what institutions we're designating as financially and systemically important and those that were not and therefore allowed to fail. Because if we keep stepping in every time this happens to prevent contagion and bank run, which clearly and to be totally transparent, it is vitally important, we really run the risk of this moral hazard because more and more people are going to just get this crazy idea of offering higher interest rate than is a higher interest rate on deposits than is sustainable, and then that incentivizes them to take too much risk in their loan portfolios, which is inevitably a bad thing. So we need to meter this somehow. And part of that, I think, should be raising the FDIC limit. The other part of it that the federal government has started to dive into is limiting the amount of deposit growth in banks on a year-by-year basis. The federal government currently inhibits the size that banks can grow to. And if you remember, that was part of the penalty for Wells Fargo for all their fraudulent accounts that they were opening a couple of years ago, is they had to do certain things to be able to grow their balance sheet again. That's all still true. But on top of that, the federal government doesn't allow banks to grow into these massive entities that to where they've reached beyond the point of no return, to where if they go through some financial stress, the government is forced every single time to step in and bail them out. So there are limitations on how large a bank can grow to. Silicon Valley Bank was not big enough to run into those limitations, but they grew at such a rapid pace, an unsustainable pace, that they got themselves into a really poor situation by virtue of their deposit growth. And so the two things that strike me as low-hanging fruit, if I were a federal regulator, are raise the FDIC limit to be more applicable to more businesses and inhibit the amount of growth that banks can, or the amount of deposits banks can take on a year-by-year basis. And this is coming from someone, it sounds like this might be very pro-government, left on the political spectrum. I consider myself really moderate, all things considered, pretty maybe conservative fiscally, but I'm more, let the markets work things out because they're a far more efficient allocator of resources than the government is. But this is a situation where we have this mix of government intervention for the benefit of all the stakeholders, which is pretty much every citizen in the U.S., and that really flies in the face of how efficient markets exist. And so because of that, we have to have some balancing act. And I think the two most obvious places to look are just raise the FDIC limit to where it actually works for more businesses, because individuals, by and large, the $250,000 limit is fine. The vast majority of individuals in this country have less than $250,000 in cash. I think about half of the citizens across the United States have less than 1 month's worth of expenses and savings, as a matter of fact. So for individuals, the $250,000 limit is fine. But if we're going to offer some kind of safeguard for our economy, the vast majority of businesses in this country employ fewer than 500 people, but have more than $250,000 of cash at risk, which makes this a pretty big issue. So maybe you bifurcate these things. Maybe you have an FDIC limit for individuals and another one for legitimate business entities. I don't know. I'm kind of throwing out possibilities here, but again, those are two relatively obvious things I think they're going to need to look at. But for right now, the most important item is nipping this in the bud and getting in front of the contagion risk so more depositors don't feel compelled to yank their money out all at once. Now, that's where we're at right now. We've got this moral hazard issue. It hasn't spread too much yet. The contagion hasn't spread. Again, First Republic is currently in talks to raise assets somehow. But this is a big issue. The stock markets, as a result of this, have been somewhat volatile. They bounced around for the first day or two, but they really haven't lost that much ground because of the way that the Fed stepped in, and I think that's a good thing. It's just something that we need to monitor, and another consequence of institutions taking interest rate risk when they really didn't have the capacity to do so in the first place. So I hope that clears some of this stuff up for everybody. Again, I've been taking in and reading as much about this as I can. This is how I see it at the moment, but this kind of stuff changes somewhat rapidly. So it's possible that next week we'll have some major happening or occurrence that we'll want to talk about next week too. So I hope this was helpful. Reach out to us if you have any questions or issues on this matter you'd like us to address in a future episode, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.